Afternoon, I welcome you to today's Trading Spotlight webinar here together with Admirals. Today is an interesting day because we want to prepare the Fed rate decision next Wednesday, but this will be, I think, heavily affected by the inflation print, which we can expect to be released next Tuesday. And it's not just that we will get an idea on the inflation next Tuesday, but we have already a very great indication, which was released just 30 minutes ago. The producer price index came in hotter than expected. What is hot in this context? We will define this. It came in significantly below the pre-market, not the pre-market, the pre-monthly or the month before, but still above what was expected from market participants. And now the interesting thing will be, and this is exactly what we want to use to formulate a game plan or formulate a trade hypothesis. We want to then look at the reaction and interpret the pattern we can right now see in the market, and then draw some conclusions out of how to trade the Fed, what to expect from the Fed next week, and in addition to that, not just what to expect, but also what to make out of this from a trading perspective. Some of you probably will say, well, we are about to enter a very unspectacular phase now. The next week is in fact the last full trading week. In fact, this is not really true. The week after is also tradable, let's say, before Christmas. But I think it will thin out dramatically. And that being said, means that next week is the last week of the year in which I expect volatility and action to happen. And then so it could be that here the event itself will trigger some enormous volatility, but we want to be prepared as good as possible. So before we start, first of all, let me share my screen, and let me, for all of you now watching the recording on YouTube, this is not relevant for those right now in the live event here via Zoom. If you watch the recording on YouTube, please make sure that you leave a thumb up here if you enjoy what you will witness in the upcoming minutes, if you can draw something positive for your trading out of it. And also subscribe to the YouTube channel from Admirals. We want to give a little introduction around Admirals, the broker behind this trading webinar series here, which I'm happy to hold with my colleagues Theo and also Paul. So Admirals is a broker which is in the industry for, I think, I think 20 years is fair way to put it. I think that there was an anniversary, but it's a long time. So long in the CFD and FX industry, and one of the most recognized and probably well-known brokers with a very competitive offering when it comes especially to DAX trading. So I'm located in Berlin in Germany, and usually we refer to Admirals as the DAX expert. So the broker which has one of probably the most competitive offering when it comes to DAX trading. So if you're a DAX trader, you should definitely check out admiralmarkets.com, the website, and check out for further details. In addition to that, also they are very competitive when it comes to FX trading, very tight spreads, very good order execution, very fast order execution, very, very low commissions. So definitely worth your attention. In addition to that, equity trading, also the invest part, something worth to check out. And plus fully regulated, certainly around the globe. So you should also check out all details around regulation. So there is some leverage is a big topic in this industry, certainly. And there's full SISEC regulation, there's full FCA regulation, but in addition to that, there's also, for example, a regulation in Jordan. Sometimes there are promotions, let's say, or offers which are exclusively connected to the, let's call it Jordan entity, and then the regulation behind that. So to get all details on that, also check out the website for further details. And unfortunately, I have no slide prepared, but let me just check before we head here to today's agenda. Let me just check the website. I just hope that I don't promise too much now, but there will be a great event next week on Tuesday together with Paul and Theo. And I'd like to invite you here to the Santa Claus event next week. So it's a Santa Claus event. I call it that way. So in fact, it's the question, what's in store for 2023? It will be a discussion between the three of us, and we will discuss our topics we usually discuss here within our trading spotlight webinars. Let me just how to call this. Let's call it the Merry Xmas webinar. Okay, so that's probably a good way to put it. Very important to note, it's a client-only event, so it's a really special event. If you're not yet a client, please also check out the website, respectively contact Admirals for further details on how to become a client and to be onboarded and registered for this event. But what we want to talk about is we want to talk about fundamentals. In my case, I just filled in some slides and made sure to be well prepared for the event. What I want to talk about is not inflation. In fact, it was a very hot topic in 2022, but I want to talk about employment and why I think this will be a big topic in 2023. I know that Theo will talk about the trading psychology and neurotransmitters in this context and how they affect our decision-making process when it comes to trading. And I also know that Paul will talk most likely about something price action related. And so we will combine these three topics. I know it will be a big event, a fun event, and I really invite you to join us there. And so now come back to today's agenda and what we want to do. So first of all, if you're not familiar with that, I want to introduce to you a concept which is, I think, of high importance, especially in the current environment, the so-called Fed Watch tool. But it's not just the Fed Watch tool, but in addition to that, I also want to guide you through something we refer to as the Fed dot plot. And I think this one will be, as it was, in fact, in September already, but it will be hot again, and market participants will really closely watch if there's any change in this dot plot, especially related to what to expect, what's in store, and not just 23, but in store from the Feds in terms of rate decisions then. And not just that, but also we want to then use this information as our fundament, let's say, and then formulate a trade hypothesis and a plan for, in this case, NQ100, so the NASDAQ, but also gold and probably dollar JPY. Not really sure if we want to dig into dollar JPY. Probably we'll go for EURUSD because the ECB then is the next central bank. I'm kind of surprised, to be honest. I thought that they will hold their press conference respective rate decision yesterday, so on the 8th of December. But in fact, they will now go for sometimes a Christmas present. Probably they will deliver whatever it will be, but probably EURUSD is a little more of interest for us. So before we look at the charts, first of all, I want to now guide you through the Fed Watch tool. And by the way, also, let me just copy the link here, share it in the chat box. Fed Watch tool. And we will go there, in fact, in a few seconds. I just want to make sure that there was no big change now taking place after the PPIs, which were just released around 30-40 minutes ago. So what we have here is, in fact, two columns, and they show us what the futures market participants, futures traders, expect from the Fed to do, in this case, at the next meeting. So what you have here is the current target rate in 300, or right now it is 375 to 400. And then you have the columns here with a percentage above. This reads 79.4. This reads 20.6. And there you can see that there's 425 to 450 and 450 to 475. What does this mean? Well, nothing more than that around 80% of market participants expect the Fed to hike rates by 50 basis points at the meeting next week. So this is in fact what to expect in terms of the rate decision. What I'm kind of surprised by is that we are still seeing around 20% of market participants expecting the Fed to hike 75 basis points. That's especially surprising because there were quite clear comments from Fed members, also Jay Powell last week on Wednesday, which triggered a massive run on the upside. You've probably seen that. That was a strong push higher. In fact, it drove the S&P 500, for example, back above 4,000 points, back above the 200 SMA, for example. And mainly due to the fact, in fact, he didn't say something we didn't already know. In fact, when you read carefully through the Fed statement from the 2nd of November, the last Fed's release, well, then you will come to the conclusion, in fact, there was nothing really new what we heard around or from Jay Powell. Then probably that was also the reason why we were kind of, let's say, bearish over the course of the last week or the last days. In fact, Monday, especially Tuesday, we've seen some acceleration on the downside, even though we didn't drop. In case of the S&P 500, we didn't drop 3,900. But coming back here, the communication was quite clear. It wasn't just Powell. There was also other Fed officials who said, well, we might slow down in terms of hiking rates. Slow down means if you have the rate hikes of 75 basis points, well, then slowing down, especially looking at the Fed watch tool, means nothing more than, well, we go for a rate hike, yes, but we won't hike 75, but 50 basis points. Again, surprising that the market here still sees with a 20% chance a hike of 75 basis points. But I think it's a done deal. So this is no big deal at all because everyone knows what to expect. What is of interest, and this is something what the Fed Watch tool provides us, it provides us with a look into the future and what to expect from the Fed, or especially not from the Fed, but what the Fed delivers. This is something we'll find in the dot plot, but it's more that we can use market participants to get an idea on what they expect. That's probably a better way to put it. And the great thing about this Fed Watch tool is that you can click into the future and have a look here. Let me just probably share this with you here. So the website, the link I shared, guides you over here to the Fed Watch tool. If you scroll down a little, and then you will see, let me just, by the way, check out. Okay, came down a little. That's probably the reason why equities are right now down. Let me just check here. So DAX 14,300, nothing big. Pre-market, S&P slightly lower, NASDAQ slightly lower. Yes, well, because right now the market is reacting to the PPIs. We will go into details here in a few seconds. And now we're giving back some of the gains we've seen in the pre-market. I'm right now having here Tesla on my screen. We saw a push above 175 in the pre-market, which is kind of an interesting level, by the way, because the last days we've seen supply coming into 175. There was no breakthrough. So this is an intraday level I really have a look at, because it gives us kind of an inflection on the upside when it comes to what to expect. And now PPIs come in hotter than expected. Again, hot is, I think, relative in this context. And now market participants are seeing an increased likelihood that the Fed will probably go for 75 basis points. I don't think that this will happen. Probably then, if we are held back now, probably then we'll get to see some kind of sharper push on the upside once the Fed comes out with 50 basis points. But we want to look into the future, and why I think this doesn't matter that much, let's say. But what we want to do is, let's have a look here at what the market is expecting in the first half of 23. So you have the tops here, and there you can see there's dates on them. And I just clicked on the 14th of June, 2023. And there you have also columns. And this is in fact the probability, or the, in this case, target rate market participants seeing or expecting then. from the Fed here to be delivered on the or in the first half of the year of 2023. So let me just make sure that we are all on the same page. So if we have 375 and 400 to 400 now, and we go for 50 basis points next week on Wednesday, that means we are then at 425 to 450. So 425, 450. We then look into the future to June and see that the futures traders are right here. So you have to sum up all these columns on the right here, that they see the Fed target rate to be at 500 to 525. So now you have a gap in this case of from 425, 450 to 500, 525, you have a gap of 75 basis points. What does this mean? Well, that in the first 6 months of the year, we expect here in February, March, and in May, the Fed to hike another, probably taking June also into account. We expect the Fed to hike another 75 basis points, which equals, in fact, to 25 basis points, most likely in March, probably another 25 in February already before, and then going for a next 25 in May, and not doing anything at all at the June event. So then really slowing down to zero, and let's see what will happen. What happened in the first half of 23 to the inflation, for example? Did it come down even further? How's the employment situation looking like? So this is something what the Fed will likely do. And now, in fact, so if we can already project this outlook into the future, any change here, so any kind of pricing out this, let's call it hawkishness, any kind of, well, we expect the Fed to hike, yes, but we expect her to stand at a target rate of 475 to 500 in the first 6 months or in June 2023. Well, that would mean we are pricing out here these, let's call them hawkish columns at the end. In addition to that, now you might wonder, why should the Fed do that? Why do you think that this will happen? Well, because if you now go one step further, not just to June, but go to December, and there you can also have an idea on where futures markets is pricing the target rate already. Well, what can you see here? Well, you can see that more than more than 60%, nearly 70% of market participants expect the target rate to be 450 to 475 in December 2012. So now you might wonder, wait, we just, well, you just showed June. In June, we are here with a likelihood of over 50%. So more than half of market participants expect the target rate to be 525. And then if you go to December, we are at 450 to 475. This is 50 basis points less than that. Exactly. This is exactly what the market is expecting here. So hiking rates will most likely slow down the economy. In terms of big tech companies, for example, which will then probably trickle down to smaller companies. Will most likely stop hiring people, probably firing people, laying them off. You've seen the headlines when it came here to Meta/Facebook, when it came to Amazon, when it came to, I think, Hewlett-Packard, Pepsi made headlines. So it's not just a big tech or social media companies or something like that, but it's the overall economy, which is right now shrinking, respectively, which is laying off people because money is getting more expensive due to the Fed hiking rates. The economy is slowing down, and we are most likely to enter, probably we're already in a recession. I mean, certainly some will argue, what kind of recession is that, where you see such strong job numbers, for example? Well, but I ask, well, the numbers we've seen last week, non-farm payrolls, and we were all here together and traded this event together. So the question was, where were these jobs created? And these are not high-wage jobs, let's put it that way, but they are low-wage jobs. They are also part-time jobs, which are mostly created there, which is in my personal view, not a sign of a strong economy, but it's more a sign of, well, people have to probably have more than one job to make ends meet, for example. This is not a sign of a strong economy at all. And the more restrictive the Fed now presents herself, the more likely it is that this development will accelerate, which means nothing more than the Fed will more likely than not rather sooner or later be more dovish, so meaning cutting rates again and countering this negative effect on the US economy. So that being said, and that having in mind, already gives us an idea on, okay, what we will look for. In fact, the question will be, what will the rhetoric look like? What will the Fed deliver in terms of the speech from Fed Powell's press conference, but also more let's call it data-based or more concrete. What will the so-called economic projections deliver? So that being said, let's here go to something we also made a topic in September. These are the so-called economic projections. This is a PDF which will be released with the Fed rate decision and also in addition to the press conference, which we will hear. And within this, you have some data and you have some nice lines and so on and so forth, and looks a little nerdy till page 4. Page 4 gives us a nerdy picture, but one which will have a dramatic impact on what to make out of the Fed. This is the so-called dot plot. Each dot here represents one FOMC member. So, which means, let's say you probably have heard of Mester, and you have probably heard of Powell, and you have probably heard of, I don't know, I don't even know whose names are. I'm not even sure if they are still in charge after these insider trading stuff, but Rosengreen and Williams and so on and so forth. And then you have something, St. Louis here with James Bullard, for example. Each of these dots represents one of these members. And the dots then, they are asked, or they have to write down, okay, where do you expect the Fed target rate to be in 2023, for example, at the end of 2023? What you can see here is that the majority of the voting members within the Fed expect the Fed target rate to be 475 to 500 around. So this is what they're expecting from the target rate to be at the end of 2023. This is interesting because once again, let's recall what we just said. This is what the dot plot suggested in September. That was, by the way, before, way before we've seen. Let's coming here to trading economics and coming to the inflation rate. That was before we saw this deceleration, let's call it, and the drop in inflation. So the data was released, or these economic projections are based on an inflation print 8.2, 8.3%. We came in last month at 7.7 and are most likely to drop even further in the days ahead. And I will show you why I think that. This is then where the PPIs come into play. And so they were really expecting to hike more aggressive. And also, in addition to that, recall the rhetoric from Fed Chairman Powell at the beginning of November. He was talking about he was talking about that the ultimate rates level will be higher than what the market expected. Well, where does he get the information from what the market expects? Well, this guy has Google himself, and he knows where to find the Fed Watch tool. So he looks at that and he can see, okay, well, the market is expecting 5% as our ultimate level, and then he says, well, guys, we will be above that. Look at what the S&P did out of that. Look at what the Nasdaq in this case made out of this. Let me just zoom into here. So that was September here. There you have it. So this is the 2nd of November candle. deep breath. We pushed to the yearly lows. We didn't make new yearly lows, but we pushed deep into the red because the market, or especially Jay Powell here, was very restrictive in his rhetoric. And it needed the inflation print then several days after, around 1 week after that, here to push us significantly higher and to new monthly highs. By the way, we're consolidating at around the highs of this day here, in fact, around 11,650 points. But looking at this here, coming back probably to the, let's go probably back here. So the market is already expecting a dovish tone, let's say. And this now brings us, so again, the Fed is expected to cut rates, and we can see they expected hike or the target rate to be between 475 to 500 at or in their economic projections in September. The market is already scaling back with their expectation, especially over the course and into the close of the year 2023. And they're already 25 basis points below that. And this is, in fact, the question we have to ask ourselves, respectively, we have to answer for ourselves to then formulate our trade hypothesis. So let's come here to the presentation, and let's have a look here at, so this is a screenshot from the dot plot September meeting. By the way, I can also share here the link, by the way. It's probably good so that you get an overview on where you can play around with this yourself. And by the way, I give you a little hint. The URL doesn't change, respectively. The only part changing here is the date. So next, if you want to have here the December meeting, which will take place on the 14th of December, then just change this to 12 and 14 here at the end, and then you will get the economic projection. So you don't need to Google that or something like that. You just need to save here this link. I just posted in the chat box. And so now coming back to the presentation. So you can see here, this is where we are, 475 to 500. And now you can see the Fed Watch tool can already be found here. So within this range. Why do I say that? That's coming back here to the Fed Watch tool for December. You can see it here. So I used both of this information. So I used here, in fact, all these three columns to get a bigger, let's say, bigger picture, 400 to 450, 475. So this is, in fact, where the Fed Watch tool can be found. And this is for 23. So the question for us for next week, Wednesday, is, do we expect the Fed to come out with their economic projections and lower these dots? So, or the FOMC members, will they come out and say, well, we expect the economic situation, let's say, to darken, inflation peaking out, but employment probably picking up, which means we have more room to be more dovish and most likely also start cutting rates over the course of the year 2023. Really doesn't matter whether we start in the first half, even though, well, certainly it matters, but in the second half of the year especially. So this is the question for us to answer for our trading, in fact. So the question is, do we think this is realistic? Do we really expect our picture, our view on the overall economy? Is it really realistic that this will happen and we will lower these expectations here? If we answer this question for us with a yes, well, then it's time for us to formulate a game plan, look at the markets we want to trade, we plan to trade, and say, okay, if this really happens and they lower here the dot plot from 475 to 500, I'm sorry, and we come in, I don't know, with the majority here somewhere around 400 to 425, which is below what the Fed Watch tool expects. Well, this is most likely bullish for equities. So bullish for the S&P, bullish for NASDAQ, bullish for gold. This is also bullish, most likely for currency pairs like EURUSD, because the US dollar is likely to drop based on that, even though I have to say we have to probably wait to formulate a thesis based on that, what the ECB will deliver the day after. So most likely we should probably focus here on NASDAQ, respectively gold in this context. If we answer this question with no, and for whatever reason, and we say no, we don't expect the dots to drop here, well, this is likely bearish for equities. This is also likely bearish for gold in this case. So roughly speaking, we will now draw a clearer picture when looking at the chart. But this is what we want to use as our thesis. So first of all, we have to understand the big picture. So where do we stand? Why inflation matters, especially the release before, where the Fed stands, where the market stands in terms of the Fed watch tool, and then paint a picture, say which side do we favor in our trading, and then use this information, and based on this information and our BS, let's say, formulate a trade plan, and then go with our plan and trade it accordingly. So now, why do I say? Well, you might wonder, okay, where do I stand? Probably we take it from there. So I think it is realistic. I think it is very realistic, in fact, that we will drop here. And now you might wonder, why do I say that? Well, I don't know where inflation numbers will come in next week. But what I know is what directly affects CPI, Consumer Price Index, Producer Price Index. And it's in fact forerunning or a front running. It's not forerunning, but front running. It's most likely front running the consumer price. Why? Well, if you're a producer and you want to sell a good, you have to buy stuff you then work with, create the product, and then sell it. Certainly you have costs. The higher the costs, well, certainly the higher the price the consumer has to pay. If you, let's say, need oil or, I don't know, gas, whatever, which is likely because energy to probably build something, create something, whatever it might be, well, and these prices are high, most likely you will have higher costs, which means the prices for the consumer will rise, which means inflation will pick up, certainly. So prices will pick up. If you see a peak out and the prices for your energy, let's say, or the product, the price you have to pay to create the product which you're planning to sell, well, you can certainly also take down the prices, which means you will see a kind of top out in inflation. So producer prices are right now a very hot topic. And as I already said at the beginning, well, let's go back here. Producer prices were just released, and you can see it there. US producer prices rise more than forecast. So let's just here be clear. If you wondered, let's come here to the, let's say, 5-minute chart. So where does this flush come from? It comes from the producer price. So you can see the timestamp is clearly at 2:30 German time, so 1:30 UK in this case. So flush lower, and we're dropping, what is this, 11.7, 11.5, it's 200 points in the NASDAQ. So like an instant, you go 200 points down. Why? Well, if producer prices come in higher, hotter, they don't really came in hot, they still hot, but you will see it cools down. But this is the next step. So they come in higher than expected. Well, higher expected means the Fed is likelier to not be too dovish next week, which is bearish for equities. So this plays to our thesis, expecting lower inflation coming in and the Fed to be more dovish because it has more room to act to counter any negative impulses on the employment situation. Well, if it comes hotter than expected, this room for maneuvering, let's say, the monetary policy path, it shrinks, which means this is bearish for equities. So this is the simple explanation. But first of all, price action wise, this is the scenario I expected, in fact, because expectations were already quite low. So it was likely that they will come out hotter than expected, again, hotter. And this flash scenario plays out. But I, in the morning, there was a client asking me, hey, Jens, what do you think? If the numbers come in hotter than expected, okay, what do you think? So we see a flush, okay, that's something I get, but then what's after that? I said, well, most likely what I favor, let's see if this plays out. I then have to focus on place where my thesis most likely will really play out the nicest way, let's say. And I think that this is in Tesla right now. And this is if we make it and hold above 175. So this is breaking it down to this point. But I said, well, most likely reaction will be similar to what we've seen here last week, with a flush out on the downside on the non-farm payrolls, which came in better than expected. By the way, if the employment situation does not worsen as much as you expected, but in fact seems quite healthy at first glance at least, well, the first reaction will be down in equities, because it makes it more likely that the Fed won't be as dovish as you expect her to be. You see the flush lower, and then after we flushed, there was no follow through on the downside, but instead we bought it back, and we saw quite strong weekly close. And I said, this is the most likely scenario I expect for today. If we get to see such a spike on the downside, expect this spike to be bought back. And at minimum, go back towards 11,700, probably even higher than that. Now you might wonder, why do I say that? Why do I expect this? And then right now it looks quite solid. I mean, we are not making new lows. So it's 6 minutes into the Wall Street Open, or after the Wall Street Open, we are slightly flushing, but no further lows. There's no sellers stepping in. There's no step down of the offers or step down of the bids and offers stepping down or something like that. Nothing you can see here. Right now, we are stable and more likely to see a drive higher. By the way, I also see here Tesla making it above 175, for example. So also this is playing out. And you might wonder, why do I say that? Let's go back. Let's go back here to producer prices. And let's click on this. So, and by the way, this is the monthly. Let's have a look probably at the yearly. Probably this is a little more impressive, let's say. So last month, we came in at 8%. By the way, they upgraded it, so they upped it by 0.1 percentage point. And we were expected to come in. So here you have the consensus at 7.2. I think this is massive. I think this is very, very low. So it was likely that we won't go below that level, because this is already a massive drop month on month, at least. And so I said, well, likely we come in as expected, probably a little higher than that. The website, which is running here, Trading Economics, TE in this case, they also run a forecast based on their models, and they came already in at 7.3. And that was something more likely, to be honest. So it was a quite drop, let's say. So 7.3, 7.4. But now the thing, what do we see in terms of market expectations? So you expect a first reaction to the news itself, which is similar to what we've seen the months before, right? So when inflation came in hotter than expected, and inflation was the big topic, we've not just seen the market reacting initially, but also, and this is more interesting and more important when it comes to equities trading, what is the yield market doing? And here you saw that yield levels spiked higher and held these levels and then continued to rise, which in addition to that saw then expectations rising that the Fed will come out more hawkish than initially expected and anticipated to some extent, which means, okay, well, then the market is potentially dropping further, or there will be a follow through on the downside, because let's say a more restrictive monetary policy approach is toxic for equities, roughly speaking. Right now, what do we see here? Let's go here to June. What did we expect? So I made the screenshot before the event, so we have data here. Let's go back to that. So this is what we've seen before, 37 to 35. So here now let's come here to, what do we stand right now? 38, 16, slightly above 50%, slightly below 50% before we came into the event, but nothing big of a change. What does this mean? Well, that means that the market is already saying, well, most of this hot, let's say, print is already priced in. And in fact, it's not really hot. It doesn't counter our thesis around a more dovish Fed. In fact, I would say it underlines it. It supports this outlook. Why do I say that? Well, again, producer prices are directly correlated to consumer prices. Now, there's a great way, by the way, here, there's a great way now to visualize that. What I will do is now I will compare this producer price change here. I will compare this with the United States inflation rates. And now you will see something fascinating. In blue, you have the producer price change. In black, the black dotted line is inflation. What you can see is the blue line front runs the black line. You can see that there has been kind of a top out here around 10%. Yeah, around this. Oh, not 9. I'm sorry, 9%. It was 9%. We rolled over already, and we made this a topic, by the way, in several webinars in the past. So you can just check out the YouTube channel from Admirals and check out the events we did in the past. So what we formulated there can be seen here. So we made this rollover tendency, let's say, based on looking at, for example, the ISM here, and there the paid prices component. So it's not the ISM itself which is of interest first, but it's a subcomponent, which is employment, which is also paid prices. And again, paid prices are directly correlated to inflation, certainly. And if you say paid prices dropping, well, you expect then inflation rates to rather sooner follow this drop in paid prices in the ISM. And the same is true for producer prices, because you can see here, producer prices are coming down. They're really accelerating now on the downside. And this black line rather sooner or later follows, which means, well, yes, we came in hotter than what was expected. We didn't drop as much, but we dropped significantly compared to the year-on-year change, which we've seen the month before, which means it's likely that inflation will come below expectation, respectively, not certainly or below expectation. Let's see where the consensus is, but it comes most likely below what we've seen in the month before when it comes to inflation. 7.7 was the data point last month, so most likely we'll come in at 7.6, 7.5. We see a cool down in inflation. This adds fuel to the speculation that the Fed will be less restrictive in her monetary policy approach. And this is exactly why I say, well, we probably initially drop, but it's no surprise to then see the market making back these losses. And I think this is exactly what's happening right here. So this is what we get to see. Let's see if it continues. So I don't think I'm the smartest guy in the room. So when I can formulate this idea, everyone else can. And will most likely, and probably even earlier than I, and already anticipated that. And there's no further demand now pushing us higher. But most likely, we will make these losses back. If not today, probably into the start of next week. Then we have the inflation data, and then we take it from there. And let's have a look here. So I think that there's a good chance now that if we can close above 11,700 points, there's a high chance that with the inflation data probably already, we get to see a test of 12,100. And if we make it above that level, then that we continue to see a follow through, and we have kind of a, let's call it, Santa Claus rally, most likely in the NASDAQ. The same is also true here in the S&P. So very similar picture. Certainly very similar picture. And here we already went for 4,000 now on the upside. We didn't make it to that level, but I wouldn't be surprised if this plays out, this formulated plan, that we will make it above that level and probably see a similar run as we've seen last week, with 4,000 to be on the table already today. And here's the NFP run, and we made it above that level later that day, and also pushed here towards 4,000, nearly 4,100, and above the SMA 200. Not sure if this will happen today. I won't be too bullish now, because I don't see the numbers to be extraordinarily important, but they deliver a good indication. And especially next week, we want to be as well prepared as possible, and then use this knowledge now for the inflation. So I could imagine, again, a run back in the S&P, back towards this level, probably even 4,000. In case of the NASDAQ, back towards 11,700, closing above, and then continue to work higher to push it higher here. And I wouldn't be surprised to see initiated, thanks to the FAT then on Wednesday, a break here above the November highs, above 12,100, and further gains then into the yearly close up to 12,700. So that's it. I promised gold. I'm sorry, I promised gold. So what do we expect from gold? I expect gold to, it's likely. I was surprised to be already in the morning. I didn't expect gold to touch 1,800, but we touched, and I wouldn't be surprised now to see a break above 1,800. I also think, and we are entering a bullish seasonal window now for gold also. I expect gold to now clearly make it back above 1,800, and probably see in the weeks ahead a run as high as 1,870, probably 1,880. This is, by the way, a scenario in which you don't really think that the US dollar performs well. So I wouldn't be surprised to see a drop in US dollar as well, even though, again, you don't want to be long EURUSD. I mean, certainly you might say, hey, we've just seen a strong run. Why not see a pushback above 106? I think this heavily depends on the ECB. And if the ECB will come out more restrictive than market participants anticipate, I don't think so, to be honest. I think that they really love to see now more easing or cool down in inflation, because they don't want to hike too aggressively given the developments in the yields area, or yield market, especially in southern periphery states like Italy, and don't want to be too aggressive, too restrictive there. And that being said, I think that EURUSD has limited potential on the upside. If you want to play gold, I'm sorry, if you want to play the US dollar from the short side, expecting a more dovish stance from the Fed in the months to come, I think gold, especially if we make it back here above 1,800 and consolidate, is a better play. It's a more attractive play, risk reward wise, I think. So that's it from my end. So I hope you enjoyed this event. In fact, let me just, by the way, I will, because I talked about contacting, especially in regards to the special, the Christmas special, together with Paul and Theo. So if you're interested, check out Admirals here, contact Admirals for further details. And also, in addition to that, I made some comments on the market, what I expect, so on and so forth. Please read this risk disclaimer carefully. So this is no investment advice. This is educational purposes only, how to build a game plan and hypothesis based on the information we have from a fundamental perspective. And if you make any trades based on that, happy trading, yeah, happy trading. But all the risk is on your side. So you can keep all the gains, but there's losses also involved when trading the markets. There's risks involved. So please read this carefully, and talk to you then next week on Tuesday together with Paul and Theo. I really look forward to it. Wish you a nice weekend. Enjoy yourself. Talk to you next week. See you. Bye-bye.